Hey, it's Jim, and this is level 3 of the CFA program, the private markets pathway, and the learning module on private real estate investments. I want you to consider the vast breadth of real estate investments that are out there. I wonder if you think like I do. Next time you get in your car and you're driving around for an extended time period, I want you to look around and imagine that all of those real estate properties that you see are part of your personal portfolio. I mean, what do you see when you drive around? You see office buildings, you see apartment buildings, you see convenience stores, you see retail stores, golf courses, miniature golf courses, all sorts of stuff out there. Now, of course, and when I say we, I mean, regular kinds of investors, we can get exposure to that type of an asset through mortgage-backed securities or maybe a REIT traded on an organized exchange. But of course, those are all public stuff. Our focus here is on private real estate investments. So imagine that we're super high net worth investors and we can actually directly buy golf courses or apartment buildings. And that's pretty much what this learning module is all about. Now, personally, I like to think of things in terms of the silly examples that I come up with. When I watch James Bond movies, especially the old Sean Connery movies, I always think, man, how cool would it be to own that stuff? Go back to that very first Dr. No movie, one of the great movies of all times. Boy, wouldn't it be awesome to own that cement factory that James Bond is driving around? Wouldn't it be awesome to own the hotel that James Bond stays in Kingston? How about that restaurant and bar that's right on the Caribbean Sea? How about the actual estate that Ian Fleming owned when he wrote all of these James Bond movies? I mean, the experience of driving around in the car or watching a James Bond movie gets us, kind of the idea of what exposure we're looking for. If we have this real estate in our portfolio, I guess we could live there, right? I mean, there's no doubt that I would spend a lot of time on Ian Fleming's estate, just walking around imagining how cool it was when he wrote these novels back in the 1950s. But, I could rent it out, right? So there's income to be generated, and then I could sell it for a higher price sometime in the future. So income, capital gain, and then, of course, low correlation, which we'll talk about here. So with that little silly introduction, let's look at the learning outcome statements. And by the way, the very beginning of this learning module, the Institute is very clear, and I think it's a signal of what are going to be really good potential exam questions. So as you're looking through these LOSs, I want you to focus on the following. The Institute tells us very clearly that the focus is on features, on the economic drivers, on the valuation of these properties. So we're going to have to do some calculations here. And then, and this is why I gave you that silly example in the very beginning, the portfolio characteristics. How does this fit in to our private markets pathway? Remember, we've had good discussions on private equity. We've had a good discussion on infrastructure and some other things, especially that relationship between the general partner and the limited partner. So that those portfolio characteristics are super important. Now, notice that last one there, discuss risk and return. What I want to do is I want to alert you to a graph that shows up in the very beginning of the learning module. But before we do that, let's go back to this introduction. This is what the Institute likes to do in these learning modules, kind of give you some background information. A couple of things that I like, the Institute's never going to ask you about $2 trillion in assets under management, by 2027. But what the Institute is probably going to ask you are questions that are going to show up in this next slide. How many of these real estate investments look like traditional debt securities, and how many of them look like traditional equity securities? Now, the Institute uses the term equity-like and debt-like, so that's pretty important. And then one thing that I didn't mention in my beginning example is this concept of owning, a forest or a farm. And these things have some unique characteristics. So what was that focus there? Portfolio characteristics and how this would fit into, kind of your overall portfolio. So let's start with this graph here. Notice going up the vertical axis is expected return and risk is on the horizontal axis. So think about that risk. It's probably standard deviation. And this probably looks something like the capital market line, but it's not really the capital market line. Notice that it kind of goes through the origin down on the bottom left. But as you're looking at these different categories, and I would know the categories from senior debt all the way up to opportunistic, I would also know those little parentheses that we have on either side of the vertical axis. Mostly public, this is what I was talking about earlier. There's a mortgage-backed security in there. There's a REIT, among some other things. And then at the top, these are mostly private. So these are extra risk, which are going to compensate us with extra return. So let me just remind you, I've said this before in some of these private market pathways learning modules, that we're probably on the capital market line, at least somewhere. We start with Harry Markowitz and then we move upwards and to the right. Remember, we called that the borrowing portfolio. So there's lots of leverage up there, which then makes it look a little bit more like equity. So that's the equity-like return. It's not identical to investing on the floor of the New York Stock Exchange, and it's mostly private over there. So I think that good questions are equity-like returns and debt-like returns. So just remember the first two, senior debt and core, look like fixed income securities, and then the rest look like equity securities. We've seen this curve here. A lot of people call it the J curve many, many times. So this is important in terms of understanding the life cycle of property development. So in the very beginning, we have net income that has to be negative because we have lots of expenses that are going out. We're not generating any revenue in those early stages, planning and land acquisition, and then construction. Then once we complete it and we sign all of these leases and we operate it, then the net income becomes positive. So this should not be anything but reinforcement of what we've learned over the years in levels 1, level 2, and level 3. So let's go ahead and start with the stages that are part of the features. And by the way, we have a really cool example that our team has come up with that we're going to use throughout this slide deck that's going to illustrate all of these different stages. So you ready for this? Let's evaluate the physical site. And what is the feasibility? What is its optimal economic use? And then we need to worry about those other people like the government and regulatory bodies that have a say about how we can use things. I'm always fascinated whenever I visit Houston, which I haven't done in quite some time, but Houston has historically not too many zoning laws. So you could have a beautiful country club, golf and tennis, and then you can have an apartment building, and then you can have a convenience store, and then you can have low-income housing, and then you can have high-income housing, right there. So Houston is known for its lack of zoning laws. I'll give you just a quick example. We have a piece of property that's on the intersection of, of a pretty big highway or throughway, but there are stop signs and traffic lights throughout this throughway. And there's an abandoned building, and it's probably got 2 or 3 acres with all the parking. And over the years that I have lived here in this city, it used to be one of those old-time gas stations. You guys are probably not even old enough to know this, where you would have a gas station and you would pull in, and some dude would come out and he would fill your gas tank up and then clean your windows and ask you if you needed an oil change. So that's what it started, and that's probably, 40 or 50 years old. But over the years, it was a dry cleaner. It was a 1950s restaurant. When I passed by it when it was a 50s restaurant, this is relatively recently. I always thought of that movie Pulp Fiction. You guys ever see John Travolta and Uma Thurman going into that 50s restaurant with all the 50s movie characters as waitresses and waiters? John Travolta makes this extremely funny comment about a $5 milkshake. If you haven't seen Pulp Fiction, I'm not recommending that you see it because there's a lot of really, really bad things in that movie. But it is a great movie. What else was it? It was a breakfast bar, like bagels and stuff. It was a coffee shop. And for the last 5 years, it's just been abandoned. And my assessment is that it's abandoned and the economic use was not optimal because in order to get to this place, you don't have direct access from this road. You have to either turn right or turn left and then go down a little bit, like 50 yards, and then you can get into it. So I don't know that that is ever going to have some kind of economic use. They probably should just tear it down and build an extension to the road or something. So my point is that you've got to consider physical feasibility. You got to consider economic use, and then you need to worry about regulations. I mean, I think the easiest solution would be to make a direct access into the parking lot from, going, I guess it's going west in our town. That would make at least half the people would have direct access to it, and it would probably increase the probability that there would be some kind of success. All right, here's our example. We're going out to Seattle, Washington. Residential development of 1,500 multifamily complex. So there's our total land area, 5 acres. So here's the proposed development plan. We're going to build 3 21-story towers, 1,500 units, 1,100 square feet, and then there has to be common space. So that common space is probably reflective of the zoning laws, the local government officials saying something like, okay, if you're going to build this, then you got to put some grass over there so people can gather. Of course, in my neighborhood, nobody ever gathers in our common space or our green space. But there are some zoning requirements, right? 25% of the total land area. There's that setback. And this is interesting. In my neighborhood, we have my neighbors. They'll want to build a fence, and we got to get approval to build the fence. And that's just not homeowners approval, but homeowners association approval, but it's, the local township kind of approval. And there's a setback, so if I want to build a swimming pool in my backyard, I can't build it all the way back to my Leland cypress trees that are in the back of my property. I have to have a setback this way. I have to have a setback that way. So all these kinds of zoning rules and regulations. There's some parking requirements. Here's a good table. I imagine the Institute would give you this table with all sorts of financial data, construction footprints, all kinds of fun stuff in there. So the question then becomes, here's the land that we're considering, and we want to build this tower. We want to build 3 of them. Can we fit it in there with all of these kinds of restrictions and limitations and requirements? But down at the bottom, we say, hey, project is physically feasible. So here's a great exam question. How long does it take to do all this stuff? Let's go back to that J curve. How long does it take to do all this stuff? Well, it's not a week, right? It's some time period. And so we're having all of these expenses, and they're eating into any kind of profitability. So think of that, that's downward slope and the upward slope until we cross over into some kind of positive net income. Think of that as marginal costs. So we're spending all this money today, and then maybe this takes 6 months, maybe it takes a year. I mean, sometimes it takes longer than that. Think of companies like ExxonMobil, who do all of these due diligence for determining whether there's oil and natural gas underground. Sometimes it takes them 3 or 4 years to do all that. All right, so what do we say at the very bottom here? It is physically feasible. That's going to take some time period. Now, of course, during this time period, we're incurring all these expenses. What did I tell you to think about as marginal costs? Well, what are we going to get out of it? Well, we're going to rent this out. We're going to lease this out. So we need to figure out what our income is. And of course, you should remember this from back in level 1. We're going to call this net operating income and then project return. And so here are a couple of formulas in these rectangular colored boxes. Net operating income, what are we doing here? We are taking that effective gross income and then taking out our operating expenses and then taking out, some kind of what are we doing for maintenance, et cetera, et cetera. And then we can easily compute from that net operating income project return, and then property value. Notice we're going to call this thing in the denominator under property value the capitalization rate, and that's just another term for required rate of return. Now remember, when we go back here and we do all this stuff, we're probably going to use lots and lots of debt, so that capitalization rate is probably heavily weighted towards debt financing. Continuing on in this planning stage, let's get some more data here. So $3 per square foot. Expected occupancy, 95%. Boy, that right there. I mean, the Institute will give you this on the exam, but you think about how do you determine what that occupancy rate is going to be? I mean, if you're the developer, you're thinking, wait a minute, 100% occupancy. Why wouldn't everybody in the world want to come and live in my office building or my apartment building or my townhouses? All right, expenses, 30% of gross rent. This is why the Institute asks you to spend so much time on quantitative analysis and financial statement analysis so you can combine those two to figure out what those expenses are going to be. I mean, this is a tremendous amount of work, a tremendous amount of vision, a tremendous amount of industry analysis, macroeconomic analysis, local geography, local income, all that kind of stuff goes into that 30% of gross rent. Of course, I can't imagine the Institute would ask you to spend hours trying to figure out what that is. So I'm sure that it will give you that 30%. Cost estimates, there we go, $35 million in land, improvements of $25 million, construction cost per unit, $250,000. So let's go ahead and what are we doing with this LOS? Important private real estate investment features. One of those features is what we did on that previous slide. So let's calculate these two things. So gross rent, this is really just essentially P times Q, right? So what are we doing? Number of units, 1,500, and then 12 months a year, right? We're going to do this on a monthly basis. So that 1,100 times the rent per square foot, $3. So that gets us up to, what is that, about $60 million. We take out the operating expenses, which are the 30%, and the vacancies, which is the 100% minus the 95, that gets us the 5%. So what does that get us to? That gets us down to about $38 million, right? So gross rent, $60 million, net operating income, $38 million. So what is that total project cost? Well, we just had this on the previous slide, right? 35 plus the 15, and then 1,500 times the 250 per, right? So there's $425 million. So what we can do is just put one of those numbers in the numerator, put one of those numbers in the denominator. So we're going to do the 38 divided by the 425. That gets us around 9% as a calculated project rate of return. Now, that sounds like an awful high probability question. So think about, in this vignette, the Institute has to give you, all of this stuff, and all of this stuff so that you have to pick and choose what's relevant and what's irrelevant. I love doing this to my students, giving them bunches of information and data that they don't need. And students always complain, oh, Jim, why did you give this if we don't have to use it? And I always say, you know what, when you go out and your supervisor says, hey, this is what I want, compute this rate of return, your supervisor is not going to tell you what information is relevant and what information is irrelevant. You got to figure it out. Now, how are we going to acquire the land? Combination of debt and equity. Probably lots of debt. We'll have to probably pay somebody to go out and make sure that the current landowner is the true landowner and there aren't any outstanding claims against that land, either by somebody else who thinks they own it, or maybe the government thinks that there have been some property taxes that haven't been paid. So we'll have to make sure all of those things are free and clear. Now, stages 2 and 3, what are we going to do? We're going to actually construct. So we have to hire a bunch of engineers and scientists and carpenters to try to put this building and these 3 buildings up. So we might have labor disputes. We might have to worry about going over budget. We need to worry about timelines. We need to worry about the final completion and that final inspection. And then how are we going to market that available space so that we can fill that up to? Now, remember, we were assuming 95% occupancy. Here we are in stage 4. We're going to go ahead and operate. So let's go back to one of those first private market pathways, where we had the conversation of the general partner and all of the limited partners. So the general partner is probably going to take some kind of a role in the operation of this. Of course, we want an expert. If this is a golf course, we want somebody who knows about golfing, who knows about fertilizing, who knows about sand traps. If this is an apartment building, we need this general partner needs to know about air conditioning and plumbing. I have a close friend of mine who actually I grew up with in my neighborhood, and he owns a bunch of apartments. And he said, I'm an expert on all of these things. I get calls throughout the night, and I go and I have to fix the plumbing, and I have to fix the air conditioning, and I have to fix the electricity. And I said, why don't you hire someone to do all that? He goes, because I love learning all this stuff, and I'm good at it, and I'd rather pay myself than someone else to do it. Now, he owns all these buildings himself, so he's an owner, manager, entrepreneur, all kinds of things wrapped up into one. But I can assure you that what's important to him and what's important in this stage 4 is this operational efficiency, so that what can we do? Our goal is 100% occupancy at the maximum possible monthly rent or lease. Now, remember, I've said this a couple of times, there's probably going to be lots and lots of leverage involved here. So we need some type of a metric to evaluate whether this project is going to be able to handle all of that kind of leverage. And so you guys know loan to value ratios. I'm certain that was important when you went to borrow money to buy your first house, or maybe your second or third house. I hope you guys have 2 or 3 homes out there. And then a debt service coverage ratio. So let's go ahead and talk about exactly what that means in terms of our example. So we have a bunch more stuff here, but before that, let's go ahead and introduce this extra concept, which really only has kind of applications here in private real estate. We'll call this the equity dividend rate. And what this is, well, look at the equation there. So before tax cash flow, and we're dividing by the purchase price minus the debt outstanding. So it kind of looks like a dividend that you might get if you were a shareholder in Johnson & Johnson or Procter & Gamble. But it's unique. It's unique to this real estate because we know exactly what that purchase price is. And we know what that debt outstanding might be. So let's go ahead and continue in our example. A couple of other things here that we didn't have in those first couple of slides. Appraised value upon completion 500. We borrowed 300,000. So there's the relationship between debt and equity. There's our 38 million in net operating income. Down below, we have a mortgage interest rate of 4%, 30 years mortgage. So let's go ahead and calculate those handful of ratios that we just talked about. So this is a super easy one, right? That loan to value ratio, 3/5. So there's 60%. And then for this monthly payment, we can just get out our financial calculator. You want to do this. And I'm not quite sure why the Institute brings Excel into and spreadsheet into their learning modules, because I can't imagine that we're going to have access to Excel inside of the exam, but maybe someday we will. So get out your financial calculator. What are you going to do? You're going to make the $300,000 as present value. 0 is future value. 360 is N, right? It's 30 years. And then 4 divided by 12. Now, that 0.04 divided by 12, that's in Excel. Remember, in Excel, you have to enter the interest rate in decimal form, but in our financial calculator, here, I'll go ahead and show you my favorite financial calculator. I love this guy. You enter it in percent form. So if you hit the PMT button, you get, 1.4 million, and that's monthly, so multiply that by 12, so you get 17. So what did we do way back here? Well, there's the answer, that net operating income, but let me go just way back here. So what did we do? So we got that 38 million as our gross rent minus the 5% of vacancies and all those operating expenses. So think about how much work we had to put in to come up with that calculation. And then later on here in this slide, we're going to use that as the numerator, right? That's That's an annual number, and divide by the debt service, which is an annual number. So there we go, 2.25. That means that we can comfortably cover that debt service. That's over 2 times. So what do we want this thing to be? Well, I mean, we'd like it to be higher. If it's lower, let's say less than 1, maybe suppose it's, if I move the decimal over, suppose it's 0.225, well, then we have to ask ourselves the question, gosh, what have we done? That's the ugliness of leverage. Of course, here in this case, this is the beauty of leverage. So let's do this equity dividend rate. So we need this before tax cash flow, which is going to be that net operating income of the 38 million minus the 17. We just calculated that in the previous slide of paying off the principal and interest on the bond. That's going to be the numerator, and then our purchase price was 425 minus the 300, and that gives us our equity dividend rate. So that's kind of like it's kind of like a dividend yield, 17.14%. It's not exactly like it, so make sure you know the differences between the two. All right, so that takes care of that first focus. What did I say? That first focus was all the features. Second focus was on the economic driver. So that's what we're doing here in this LOS. Market dynamics, so that makes perfect sense. Location advantage. This is why I gave you the example of that property in my town that's been abandoned for a couple of years. Let's compare that to Ian Fleming's estate in Kingston, Jamaica. I mean, that thing is a tourist attraction these days. I mean, that's prime location. The other thing that I want to mention about this is, and see if you think this is an accurate description. This is just kind of my own editorialization. Next time you're in your car driving around, find the Starbucks and ask yourself the question, boy, is that Starbucks in a prime location? And I always seem to answer the yes. And I'm not a coffee guy. I don't drink coffee. I can't imagine going into Starbucks and spending $10 on a cup of coffee. Physical attributes, of course, we want it to be attractive, right? That makes perfect sense. And then I'm going to tell you a quick story about my father before he died. And this goes back to 2006 and 2007. In kind of a rural area outside of my town, they were building hundreds of townhomes and apartments. And my dad kept saying, who in the heck is going to live in these things? Who in the heck is going to live in these things? And I gave him my traditional finance answer. I was like, well, Dad, these people have gone through stage 1 and stage 2 and stage 3. They probably know what they're doing. And my dad kept saying, no, they don't. No, they don't. And then, of course, what did I say? 2006, 2007. We had the 2008 financial crisis, which began in the residential real estate market. And when we would drive by this thing in 2009, my dad would always say, see, I told you, because nobody was living in these townhomes. So there you go. There's my oversupply example. Now, what the Institute does in the next part of this learning module is they say, okay, let's suppose that we have an oversupply. Let's take a look at our original assumptions, but then let's dial them back. All right, so what are we doing here? Revised rental rate, $250 per square foot. What was it before? 3. Now our revised occupancy rate, that's 85%. So let's go ahead and figure out how this oversupply impacts the actual metrics that were used before. So look down at the bottom. Let's calculate the revised net operating income and equity dividend rate. So let's do this revised gross rent. Now it's only 49 million. The net operating income is only 27 million, as opposed to, 38 million right before. So that equity dividend rate should be an easy one to calculate. So we still have the 17, right? There's the leverage. We still have that fixed promise that we made to the lenders. So now we have 27 minus 17. So what was that number before? 17%. Now it's 8%. So the revised dividend rate has fallen dramatically. Of course, it's fallen dramatically. Now, this is what I was saying to you earlier. How does all of those things that you saw driving around in your car, how do all those things that we see in that great James Bond movie? And by the way, if I had my pick of anything to own in a James Bond movie, how about this stupid example? I always say this when You Only Live Twice comes on. I say, boy, I'd love to own that volcano that opens up and it has, all that stuff down in the bottom where the bad guy Blofeld launches his spaceships. I'm not sure what I would do with it, but nevertheless, somehow it would fit into my portfolio. Now, I've said this, I think, at least I hope I have said this in every one of these private market pathways learning module, that what are we doing here? We've got low correlation with those traditional investments. So remember what we're doing. I've said this multiple times. Think about moving up and to the right on the capital market line. So clearly standard deviation goes up. Clearly our expected return goes up. But because of that low correlation, we have the potential of reducing portfolio standard deviation, even though we might be investing in a higher risk private real estate investment. That low correlation might in fact provide us with the benefits of diversification. That's why we have it in the very end there in the red box, reducing overall portfolio volatility. Stable income stream. I imagine if I owned that volcano, what I could do is I could rent out. People could fly over it. Maybe they could send their drone over it and they could look down and see the lava move over. Of course, it's not lava, it's fake lava. I'm guessing you guys aren't old enough to have ever seen You Only Live Twice. What a great James Bond movie that was. And then, of course, inflation is real estate is a inflation hedge. We learned that all the way back in level 1. Due diligence, you've heard me say this before. This is just hard work. So what do we need to review? Legal documentation, property and project evaluation, financial analysis. So this is why the Institute is so big back in level 1 to emphasize, what do we have? What was it, 4 or 6 learning modules on the balance sheet, on the income statement, on the cash flow statement. Now, of course, it's a little bit unique here in the real estate universe, but you need to know those basics. Market review, this is nothing more than an industry analysis or a macroeconomic analysis. And remember, the local market is probably driving this rather than the national market. I mean, I have no idea what the local market for that volcano, that was in Japan, for those of you who have ever seen that movie, what the local market for viewing inside of a carved out volcano might be, but I could probably figure it out. Sooner or later, I would be able to do it. Lease review, developer and contract assessment. So there's good potential 6 exam questions here. All right, so we did the features, we did the economic drivers. So let's go ahead and talk about the valuation process. So we can do the income approach, we can do sales comparison, we can do discounted cash flow, cost approach, scenario and sensitivity analysis. The good news is that we've done all this stuff previously in the CFA program. So this should be just a quick reminder. The income approach, of course, what that means is that you're going to have net operating income as your focus. What does that mean? We're probably going to use this in some kind of going back to Modigliani and Miller and their capital structure irrelevance proposition, where we can just put net operating income in the numerator and divide by the capitalization rate. That'll give us the value in terms of assuming that it's a perpetual private real estate investment. Of course, this is appropriate for properties that are income generating and have sustainable and stable income, and then those market conditions are reflected through the capitalization rate. I have no idea how to use the income approach for my volcano in Japan, but I'd probably have to figure out costs of helicopters and drones and how much someone would be willing to pay to fly over my volcano. Boy, that's a silly example, but it still gives you the idea that it's probably not appropriate as it might be for, like an apartment building or our example that we're going through here in this slide deck. Sales comparison, I'm guessing that you know what this is. All we need to do is figure out, hey, what did that apartment building sell for? Let's do 3 of them, right? Take an average of those 3. How about this miniature golf course over here? Let's take an average of maybe 5 miniature golf courses. How about some office space over there? I would be the only carved out volcano in the world, so I probably couldn't use the sales comparison approach. Scenario and sensitivity analysis. I love this. I have my students do this all the time. We get an Excel spreadsheet out. We do years 1, 2, and 3. Usually we stop in 3. And then we have, some kind of a cash flow statement going down the left-hand column. And then we fill in all the blanks. And then we go and say, what happens if something changes? What happens in this case if the capitalization rate increases? What if the occupancy rate changes? What if our tax rate changes? What if? And notice that third sentence in there. This is what I like here. It helps identify those risks and rewards. You've heard me say this so many times. The key to understanding all of this stuff in the CFA program is to be able to identify the risks, quantify the risks, and then manage those risks. And scenario and sensitivity analysis allow us to do this. Now, what happens in the result in my classes is that, we do a bunch of these things. And of course, if we had a Monte Carlo software at the school, then we could just press a button and have it compute 100,000 of these things overnight, and we could come back to the finance trading lab where I teach the next morning and say, hey, we have 100,000 of these. We could say, here's the worst case scenario, and here is the best case scenario. And so this is kind of what the end result is. We have a base case, right? And then we go to the right, and then we go to the left and see what could go wrong, what could go right for us. So let's take a look at another example here, the Grandview Plaza investment. Let's see. What do we have? Different market rent assumptions. High-end commercial rental market is more volatile. Oh, I'm sorry. So there are 3 scenarios upon project completion. So we've got 200,000 square feet, 150,000 square feet, commercial and residential. There's a 90% occupancy rate. There's 30%. Did we have a 30% before? Cap rate of 6%, debt service 10 million, equity invested 50 million. All right, so let's do this. Our base case scenario has a 50% chance of occurring. A lot of times in the economic world, we'll call this, kind of the normal outcome scenario or the most likely outcome, most likely, of course, 50%. And then we have optimistic and pessimistic. So think of that as, hey, if everything goes in our favor, that would be the optimistic. If everything goes against us, that would be the pessimistic. So there are some assumptions there. Commercial, 50, 45, and 40, residential 40, 35, and 30, optimistic all the way down to pessimistic. So let's go ahead and determine the property value under each of those scenarios. And by the way, coming up with those probabilities, that's not an easy thing to compute or to estimate. I mean, you've got to have tremendous background in economic theory, both micro and macro. You've got to have tremendous wisdom in quantitative methods to be able to come up with those probabilities and all sorts of other skill sets. So you get the sense here, as we're ending level 3, and hopefully you take level 3 just one time and you pass it. Unlike me, you had to take it another time, but take this level 3 and pass it. I mean, you really have to know a lot of stuff, right? There's lots and lots of breadth and lots of depth. So let's go ahead and compute this property value. So commercial and residential, we did this in that previous example. So we get about 8 million and almost 5 million. So if you sum those, you get nearly 13 million. Operating expenses, what was that on the previous slide? That was 30%. So there we get almost 4 million. So subtract the 13 minus the 4. There you go. So there's the 8.977 million. Put that in the numerator. And by the way, I'll repeat myself here. This really comes from Modigliani and Miller, capital structure irrelevance. This is their model in their perfect world. So we take that sustainable, stable, operating cash flow, here we're calling it net operating income, divided by the cap rate. Make sure you do in decimal form, by the way. And that gives us, what does that give us? About 150 million using scenario analysis. Now, what we can do is we can go and say, hey, let's figure this out under the optimistic case scenario. So we can do all this math again and we get 168 million. We can do all this again for the pessimistic scenario and we get 131 million. So what are we doing? We've got 150 is our base case, then 170 and 131. And by the way, you don't have to have just one optimistic and one pessimistic. I mean, you could have 5 or 10 or 20 of these different kinds of scenarios. Like we could have the most likely outcome, and then we could say something like, if things go kind of in our favor, and then if things go a little bit better in our favor, and then if things go really in our favor. So there's an extra 3 for optimistic, and then you could do the same thing on the downside as well. I think we learned discounted cash flow analysis in the very first learning module back in level 1. So this is really nothing interesting or nothing new. All we're going to do is estimate those future cash flows, whether they're inflows or outflows, discount them back to the present value. Excuse me. We'll have to come up with some kind of a risk-adjusted interest rate. This is ideal for long-term profitability, right? Changing economic scenarios. One of the great things that my dissertation chairman taught me was the following. In the middle of my dissertation, he looked at me and he goes, Jim, the more you know about options, the more you know about everything else in finance. And so that piece of advice is really good for us here as we're preparing for some of these later LOSs inside of this learning module. So we know about options from level 1. Options give us the right but not the obligation to either buy or sell an underlying asset. Now, those are usually considered, like stock options or index options or currency options. But there are these things called real options. And in the academic literature, they used to be called latent assets. This is really an interesting term. Latent assets. Latent meaning you're not quite sure exactly what they look like, but you know that they're there. And so the definition of a real option as it applies to real estate is the exact same as it was before. We have the right but not the obligation to do something, but that do something is not really exercising a stock option or a currency option, but it's an option. It's the right but not the obligation to engage in some future action which will increase the project value. I've given this example multiple times, and it's worth repeating. Think about the people who created the Apple iPod. You guys even old enough to remember the iPod? I was the first one to buy one of these things because I could put 1,000 MP3 music files on there, and I could listen for days and days without end. But I promise you, those people who developed that thing, they were thinking, we're not quite sure where this technology is going to lead, but it's going to lead somewhere so that we can have an increase in project value. And now what? We whip out our phones, we can play music, we can call people, we can take pictures, we can do whatever it is that we can do on our iPhones, keeping in mind, I told you this before, I'm the only one in my family that doesn't have an iPhone. I get criticized for it all the time, but I'm a rebel. All right, so the question then becomes, hey, let's be able to identify some of these real options. So think about this. We've got a couple of them here. Watch this. We've got a couple of them here. So really good exam questions. Here we have this scenario. Which one of these is the appropriate real options? All right, so you ready for this? Here we go. A delay option. What we can do is we can buy some land and we can say, let's go ahead and put these 3 towers on there that we talked about in that first example in the slide deck. But what we might want to do is delay. So let's buy the land. Let's do all of that stage 1 planning. But in the back of our mind, we're scanning the environment for market conditions. We're going to interview people out there. Do they want to live in one of these towers? Do you mind living on the 21st floor? Do we care about this stuff? What are interest rates? What is inflation out there? What we can do is we can delay it. We can say, we have these plans. Let's go ahead and let it sit for 3 months or 6 months or whatever that time period is. And then maybe those market conditions are appropriate to begin construction in 6 months rather than today because we are more confident in the outcome. Right? What did I say just a few minutes ago? Identify the risks, quantify the risks, yep, and then manage the risk. We're doing all those things here in this delay option. We can do a sequencing option, and this is very, very common with residential neighborhoods. Of course, we'll have, phase one. Let's see what happens with phase one. We still own the land back there in phase two and phase three. And what we're going to do is if phase one is successful, then we can sequence over to phase two, and then phase three, and then phase 10. Notice that bolded word there in the second bullet point, staggered execution. And of course, we can do this with office space. We can do this with miniature golf courses. We can do this in any of these private real estate transactions. And then we can switch. So I give you kind of a hint back here with the delay. We can delay construction for 6 months, and then we can change our mind. Maybe instead of building our 3 towers, maybe we're going to put a farm on there. We'll talk about farmland here in just a second. So we can convert if, notice in the bottom right there, if demand shifts. So that makes perfect sense. So the question then becomes, how do we value this real estate if there is a latent asset in there, if there is an embedded option, if there is a real option? Well, of course, we're going to start with discounted cash flow analysis. We're going to go ahead and do all the stuff that we've done before and calculate the option-free value of this particular project, and then we're going to compute the option-adjusted net present value. And that option-adjusted net present value, we could use the binomial option pricing model. We could use the Black-Scholes-Merton option pricing model. We could use Jim's option pricing model if we wanted to. But what's going to happen is, remember that the option has 2 components. It has intrinsic value and it has time value. So identifying, we can use Black-Scholes-Merton to do this, the intrinsic value of the option and the time value of the option to figure out what we want to do. So look at that first sentence there. What we can do is we can have the option to delay, the option to expand, the option to abandon, the option to switch. So we can incorporate all of those things in there. And by the way, what we can do is we can go back to that scenario and sensitivity analysis, and we can incorporate all that stuff in there to compute this option adjusted net present value. I love asking my students to use Black-Scholes-Merton to compute the value, the net present value of a particular project. I promise you that those really, really smart individuals that came up with the iPod, they were saying to themselves, man, oh man, sooner or later something is going to take off. And boy, didn't it used to be this big, and now Apple, boy, didn't I read that it's $1 trillion company? And it's all because of the embedded option, that latent asset. Now, remember back in level 2 where we had, and I'll just take this simple case, where we had, let's say, a callable bond, and we were trying to figure out how to value a callable bond. And so we needed to come up with an interest rate tree. Sometimes interest rates go up, sometimes interest rates go down. Of course, when interest rates go up, that callable bond has a higher probability of remaining just an option-free bond. If the interest rates fall, then that callable bond has a higher probability of being called. So we have to reflect the changes in those interest rates. And so what did we do? We used that, what did we call that? Backwards kind of induction. We started at the end, and we did present value and then a present value all the way back to the current price of the bond. Well, we can do the same thing here with a decision tree. We can start today, work all the way out to some kind of an ending time period. That ending time period might be, 2 years after construction if we have 85% occupancy rate. And then we can kind of work our way backwards to come up with how to value that embedded option in there. So it's very similar to what we did back in level 2. All right, let's move on to the final pieces of this private real estate. So let's look at the forests and the farms out there. So what are these investment characteristics? So this makes perfect sense here. A biological growth, right? My father, when he was alive, was a great gardener. He was so proud of his tomato plants. He was so proud of his cantaloupe and his carrots and his lettuce. And he fought a raging battle with the groundhogs and the rabbits in the neighborhood. He fought a losing battle. Those groundhogs, they laughed at him when he put up his fences. All right, so that was just a small example. So my dad loved this, but he had to plant every year. So with timberland, my dad never planted a forest, but think about it. In my area in the United States, there are tons of evergreen farms, and you can go to these at a certain time of year, and you can cut one of these things down and bring it in your house if you want to, and decorate it. And so they have trees. Can you see me? They're this big, and then they're this big, and then they're this big, and then sooner or later they get big enough to grow. Now, remember, wood is a commodity. So investing in a forest or timberland, this is a natural inflation hedge. Now, sometimes the price of lumber spikes and sometimes it falls. It's not perfectly correlated with the general level of inflation, but it gives you a pretty good idea of hedging inflation risk. And then, of course, all those conversations that we have about diversification apply here. How about this cash cycle? Let's go back to that J curve again. So initial planting and establishment. So you need to be an arborist to be able to go ahead and figure out what's the soil. So you need to be a chemist, or you need to be a biologist, or you need to be a geologist. I don't know. I'm not smart enough to figure all that out. But there's probably optimal planting areas for evergreen trees. There's probably optimal planting for oakwood trees and all these other kinds of trees. I will tell you that I'm living proof of growth. I tell you this before, I've got 11 leafless cypress trees on my backyard property, and then 5 of them on the side of my property. These things grow by 2 feet every year. It's amazing how they grow. Now, I do it for privacy and for sound, but if I were going to do this, I would love to plant leafless cypress trees in a forest because they grow so fast. Harvesting, typically 20 or 30 years, significant cash flow from sales. How about farmland? We've got crop sales. My father, he got into this gardening because our neighbors, they owned, I don't know how many acres, 1,000 acres of farmland. So I essentially grew up on a farm, and boy, I saw how they sold their cantaloupe and their tomatoes and their peaches and their apples. So, there's tons and tons of ability to generate income. Once again, it's an inflation hedge. And then I'll tell you this story. Our backyard, buttressed there was a creek, and then there was all this farmland back there. And, so we would sleep out on the farm. We had so much fun out there. But at some point, somewhere around the year when I got married, 1990 or so, the farmer, he decided to sell a big portion of that land to a developer. And now it's a big development. And the houses back there are, hundreds and hundreds of thousands of dollars. So capital appreciation. So what did my neighbor do? This farm came, I don't know who bought the farm 100 years ago or 1,000 years ago. So he farmed this land and then he sold it. And I don't know how much he sold it for, but he built himself a gigantic house. Capital appreciation. All right, so both wood, lumber, and tomatoes and apples and corn, these are all commodities, and so we need to worry about the commodity price risk, fluctuations in those risks. So we need to worry about some other things, environmental risks, right? The forests and corn, they are susceptible to all sorts of stuff. Ants and worms and dogs, and kids like me. We'd sleep out there and we'd go and we'd pick the peaches and eat them. Of course, one of my best friends was the farmer's 2 sons, and so we weren't really stealing, but we were not paying for it. Yeah, climate risk, operational risk, regulatory risk, all these kinds of things. What did I say earlier? Identify the risk. So these are some helpful things about identifying the risk. Then let's get into managing the risk. We know about diversification. We know about the inflation hedge. We know about returns. What are we going to call these? Are they stable returns? Man, oh man, prices of commodities can really fluctuate. So how do we evaluate all of this stuff here? Well, we're going to use a metric called the multiple of invested capital, and it's really a simple ratio. We're going to take the realized value of the investment plus the unrealized value of the investment and then divide it by total capital. Why do we like this thing? It's a really good measure of performance. We can compare it to other things, and it's pretty simple. There are some advantages there. There's the simplicity. We don't really need to worry about the timing of the cash flows. It gives us a holistic view, whatever that word holistic means. It's used all in terms of lots of different people use that term. I'll refer you to one of those great Seinfeld episodes where George wanted to get his tonsils out, and he went to a holistic manager or whatever. And it was also the dude. That guy was the guy in the Groundhog Day movie who Bill Murray punches one day after going through all that. There's your homework assignment. Watch Seinfeld and watch Groundhog Day. Now, of course, this thing here, this multiple of invested capital is, essentially unique to real estate, but that doesn't mean that we can't use internal rates of return or any kind of return on investment. So let's work through a final example here. Greenfield Tower. Purchase price $25 million. We're going to renovate it 3 years. Discount rate 6.5%. Net operating income $3 million. Net cash flows in year 2 minus 2.5. So those renovation costs, that makes perfect sense. Renovation costs, but then we've got this stabilization in year 4 of $7 million with a 95% occupancy rate. So expected property value, you do the math, you get the $41 million. And so what are we going to do? Take that net operating income in year 1, add that to the 41, that gets us up to total cash flows of $44 million. Divide that by the total cash outflows. What do we got? The 25, then the 2.5 and the 2.5. So that gets us this multiple of 1.47. So for every dollar invested, the project returns $1.47. So we like this as a simple kind of a metric. It's easy to use. It's easy to compare against other kinds of investments out there. So we hit those 4 focus points that I mentioned earlier. We've done all of these learning outcome statements. So I want you to take about, I'm thinking it's going to take you about 30 minutes to work on those 12 or so problems at the end of this learning module. You'll need your calculator for some, but I think we hit on most of those questions. So hey, thanks for watching. Have a great day. And as always, good luck studying.